Good morning, and want to welcome everybody to Energy and Commodity Risk. My name is Glenn Labhart. I will be your moderator today for this excellent panel. We are going to be discussing the growing demand, intermittency, fuel security, and transmission constraints, but also touching on a lot of subjects with regards to the global market and a lot of events that are occurring and how they are affecting the ability to manage this topic of uh, demand and so forth that we're trying to look at. So, from a risk perspective, we're going to speak to these specifics, and then we're going to look at it from a global perspective, and then we're going to run a poll here a couple of times, and I'll be very grateful if everybody will join us. And on the poll, it gives us a good answer to be able to give back to you as we're running the dialogue and the questions. So please answer those polls. I will be able to see them online here. I'm going to start from my left to right on my screen with Pierre. If you'll just take a moment, introduce yourself, and then we'll just go around the screen from Pierre to Al and then to Martin. Pierre?
Yeah, thank you, Glenn, for the introduction. My name is Pierre Brunelle. I manage risk, middle office, market risk at Repsol in the US. We are mainly focusing on natural gas, power, and LNG. My background is on market risk and quantitative risk, building structured products models for valuation, risk models, using AI, using machine learning, etc. So that's mainly my background. So I look forward to the discussion today. Thank you.
Good morning, everybody. I'm Al Garcia here, based out of Houston with Seguro Energy Management. We are a firm that specializes in energy management for third parties in the power and gas sector. My background specifically is power and gas trading and LNG, LPG marketing over the years. Been around for 20 plus years, Houston, Europe, always looking at the global picture, which is so interesting nowadays. Happy to be here. Looking forward to it.
Hello, everybody. My name is Martin Pich. I'm representing company MND, Czech-based company in Prague, focusing on cross-commodity trading in Europe, financial transactions across the globe. Otherwise, we are a standard utility, oil and gas production, drilling, gas storages. My background is pure cross-commodity trading for more than 20 years.
Very good. So we'll have an experienced panel here for all those that are on the call. Gina, I'm having trouble here getting through. Please launch your poll, please. I can't get the message through. The arrangements here that you're seeing from your speakers is so everybody in the audience will know we're coming at this from mostly gas and power, but cross commodities. So please take a look at this very carefully and give us your feedback as to where the priorities are, because this is what they will be speaking to, kind of from a top to bottom type approach is the way we're going to handle the questions. So from that perspective, I'm going to go ahead and just stay in order here with Pierre. Yes?
Yes, sure.
Go through a little bit, Pierre, if you will, for me. Just discuss a little bit about global market circumstances and risk issues that you're facing. You know, we've got a real thing on our hands. I don't know what else to tell everybody. I have the TV cut off, but I have 4 channels running in the background, so I can't give you the minute by minute news. Neither can the gentleman on the panel. But we want to address it from a macro perspective. So go ahead, Pierre.
Yeah, one angle I would like to point out, of course, we're all aware that the global energy market is very volatile right now. Every day, every hour, actually, there could be news impacting a different market. My point of view here and what I'd like to contribute is that the global market being volatile, this volatility creates opportunity in the sense that for structured products, we have optionality. So our view, and my view actually, is that it does allow for companies to materialize or optimize the option value. What option value? Well, there could be various different option value. In the case of LNG, it could be the cargo diversion option. So what is this value? Well, this is a complex product using real option modeling. If you were to compute this value based on pure historical data, the challenge is that historical data may not reflect the current and the forward view on the global markets. So your model might be improper. You might not capture the true option value of this cargo diversion. So you need to not only use the proper modeling, which is a real option model, but you also need to accommodate the data to make it more realistic for to proper capture the option of these assets. So that would be definitely one area of interest. And well, if you have the right techniques, the right model, you are better than someone that doesn't have it. So you are able to optimize the value of your assets.
So let me have a takeaway from that, and I'll ask you this follow-up question just generally for the flow of the group. You're very focused on volatility and optionality as the way that you have your company's risk structure and what you're looking at. Is that a fair statement?
Uh, For me, yes, there's definitely this aspect. Yes, definitely.
Okay.
And it's true
Al?
for winter storm as well, right? The winter storm that for those who live in the United States, the Northeast winter storm in late January, when the Algonquin price for Balsamont and Gaspé went to an extreme high price spike. Well, if you own assets, you could optimize that asset and generate tremendous value if you are able to unlock that value. So.
Got it. Thank you. Al?
Thank you, Glenn. To follow up on what Pierre was talking about, really, I think that I was thinking about this last night. The aspect of risk management that's really been at the forefront in the past 3 years, but especially this year, geography matters, right? We got used to having a world that was seamless in many ways for the past 25, 30 years. And it really didn't matter where your barrel was coming from or where your molecules were coming from. But now it really, so having a vessel coming from the U.S. Gulf Coast versus a vessel coming out of the Gulf, Persian Gulf, that's a big difference, and that's what you got to take into account when you're measuring what your exposure is. That's from a supply standpoint, but it goes beyond that as well. One of the things that we're doing at Seguro, we're branching into asset development here in the U.S. And as we're having the discussions on the equipment that we're buying for the for a 920 megawatt power generation asset in Arizona, we're also coming to a lot of issues with how much of that equipment is produced overseas. So how available is that going to be, and whether tariffs affect that as well. So the political aspect that we haven't had in the past is also there. You have geography, you have politics, and that changes the risk profile. But at the same time, it's an opportunity. I mean, I was looking at 70% opportunistic trading on the poll, and that's how I think about it from a trading perspective. Yes, it's difficult to manage, but the opportunity is there. It also creates a starker division between those firms that have the ability to manage the risk and those that do not, and may be more subject to following the latest headline and get whips out as the market goes up and down.
So let's back into that answer just a bit so I can label you like I labeled Pierre, okay? Because I've labeled him with optionality and volatility, and you're more of in a regional market with assets and so forth and how you're handling them. Are you focused on the volatility as the same thing, or are you having to take it more in a different capacity, more being on a linear basis of what you're trying to manage your risk as?
From it's both in a way, because even though we're focused on the asset development side, which is by nature a longer term view that you're going to take, you also have to keep in mind what's happening in the short term, because that determines the long term decision making that firms involved in the value chain will take. So still having to view what's happening on the day-to-day markets and the front of the curve, because of the clients that we manage assets for, while at the same time looking at the long-term decision making that will impact our equipment purchases as we go forward with the assets. So it's a bit of both, really. Keeps it interesting.
Thank you. Martin, I'll take it to you. You get to go last and pick up on all the good ones here. Go ahead,
Yeah,
buddy.
no worries, no worries. Thank you, Glenn. So, from the trading perspective and purely from the prop trading perspective, okay? So, the volatility, of course, is something interesting, but then we distinguish between the normal volatility driven by some predictable events, normal breathing of the market, and then you have this type of gray or black swans that we are experiencing since 2022. And this is making the decision making and the risk management much more difficult than it used to be before. So I'm here in line with Al. So for the prop trader, it's very important nowadays, or last couple of years, to have a portfolio that is combining various commodities, different market segments, so that you can maybe put aside now some of the commodities that are behaving very strangely and you focus on some other ones. So to have this ability to shift the focus somewhere else, it's very important. And for us, uh, for example, especially now with the Hormuz issue, um, we scaled down, for example, some gas storage business in Europe, logically, as we did in 2022 or 25. I mean, all these events, like the tariffs, the Hormuz and the mm, nowadays also algos that are reacting very rapidly on the headlines. This is making such a big noise that it's really difficult for some traders to handle those positions and to be kept within the limit. So you have to adjust also the view how you frame the risks.
Okay. So that tells me your risk tolerance is spread between a long dated book and a concentrated effort within the long dated book, more in the shorter term of prop. And you're having to kind of balance between the two. Is that correct?
It's kind of, I would even say that some type of transactions for the time being are not so welcome. For example, strategic positions, how you can build them if it is moving so much. So it is really focused on the short-term volatility and looking on the markets that are more fundamental so that you can handle the position in a smoother way.
Are all your traders in one room doing it together?
Well, yeah, in our case, we have different type of traders, so fundamental ones, technical ones. We have different market segments. So they are helping each other. So
Yeah.
that's team approach is always the best.
Yeah, I didn't want to set you up on that one, but I do know that some companies have gone back to a different strategy. We called it from the old days of put the tech traders or the prop traders in another room and just throw hamburgers under the door because they're going to watch the screen all day and everybody else goes to lunch. So some people have adopted that model. I find it interesting that volatility being managed is in one room, which is good. You're right. The team approach is best. Because you never know when you plug and play your traders where they're going to be or how they're going to play that.
Indeed.
What's the biggest challenge for you handling both of those? Is it a challenge kind of running it from risk that you're having to tweak your models any or do anything different with regards to demand or anything that's coming at you very specifically?
Last question to me, right?
Yes.
Yeah. Of course, we did many changes to our models, and especially as the LLC models are now so advanced. So we are focusing now on, of course, accommodating all these new aspects of the market into our models. So we are adjusting them as the life goes and the new factors are appearing. So it is coming not only from the risk side, but also from the management of the position and the opportunity side. So yes, the answer is yes.
Yes. Okay. Thank you. Moving ahead. So I'll go back to you, Pierre. In order to maintain all this oversight of risk and the optionality that you face, and I notice you're the only one that really brought up LNG, so I'm taking it that Martin is a receiver of LNG as opposed to an exporter since he's in Europe. I may be right, that may be wrong. Martin, you can comment. But from that perspective, as you're maintaining over this global, oversight of risk, what processes or advanced modeling techniques are you using to capture this as well as congestion and imbalance risk? You got these forces of the market that are going against the balance of the portfolios every day. What kind of processes and techniques are you having to use from a model perspective? Can you share a few ideas or comments about what you're doing?
Yeah, of course. Well, first thing, obviously, being part of market risk, we rely on the data that we have. We start with what we have in our system of record. The ETRM, the end of day position, is the starting point, obviously. But for optionality, or as you mentioned, to capture fundamental data change that could impact the valuation or risk, the strategy here is to start off with what we have in terms of position and then bypass the term system using Python, for example, and value these models outside the system and produce meaningful reports for it. So whether it's running a new real option value based on the new fundamental data, whether is using machine learning data to simulate gas daily price or Balmo price, given the change in the HDD or the change in the storage level or etc. fundamental data that could impact the price. That would be a strategy to do so, because the current system, although is used as our system of record, is incapable of doing that. And so rather than purely relying on the term system for valuation and risk, valuation of structured products, I would like to mention, then you can use it externally to do that. ATM system is good for vanilla swaps, simple transaction, or put call options. That's not a problem. But for complex models that require a simulation, a path dependent simulation, volatility clustering, machine learning process, well, all of that cannot be achieved in a term system. That's not possible, and that's not the intent anyway. So that would be the main approach. On that, I just want to mention that, of course, AI is a critical aspect and it definitely help building these models. It goes without saying, but there's also the risk of using AI in inappropriate way, meaning being complacent with the model, not understanding the complexity of the model, incapable of maintaining the model. All of these, model risk consideration needs to be applied even more so when it comes to complex models.
Okay. So you've got an ETRM system with models sitting outside the network that are being run
Yes.
from the front office and probably monitored by the middle office and some sort of element of AI within that. Is that about the size of it?
Well, the models are built by the middle office market risk team, yes, to provide insight into what's the value for these structured deals. Right. And
Okay.
so you would effectively, what end up happening, I'll give you a quick example. On day one, when they book this transaction, that structured deal, there's a price, there's a market value, mark to market value. We would, acknowledge a day one mark to market, booking a reserve to offset that value. That's an observable price when the two counterparties, us and another counterparty, agreed on the price. But the model will have a slightly different value. Obviously, there's other components like liquidity and etc. But what happened after day one? I mean, we need to revalue these transactions. That's where the model is also helpful. So effectively recalibrating these model reserve as we go forward in time. These structured deals could be 2, 3, 5 years out, right? So you cannot just use stale valuation. You need a proper model to do that, to really
Okay.
value the optionality to assess whether you optimize it or not.
Gina, launch me the poll too, please, will you? One last question, Pierre. How well are you and how comfortable are that you've got everything like you just spoke of in real time? Is it in real time? Is it in partially real time? So you're going from start of day to trading. How well can you keep up during the day? Can you give us just a general 30,000 foot comment and we'll need to move on to the other panelists? What
Of
kind of
course.
level do you capture?
Yeah, very high level, very quick. So, of course, end of day is like I've mentioned, as as you know, middle office market risk depends on end of day, so that remains the standard. So it's always going to be there. It's not full real time per se. I would say near real time in the sense that we have the ability to use fundamental data to adjust the price simulation. For example, we have the ability to build a margin at risk model, and which margin at risk model could be almost real time, right? So there are other components that market risk could do other than just the typical mark-to-market report and VAR report end of day. And so those are examples of that. It
Okay.
goes with the talent of the team and the need. Yeah.
Okay. All right, Al, let me pass it over to you. How are you maintaining your site? What processes, techniques, and modeling to capture what you're trying to capture?
Because of the assets that we're dispatching on a regular basis on the power side, you always have to keep all the fundamentals that affect the particular market, whether it's U.S. or in the Mexican side, which we also manage assets. So increasingly over the past couple of years, as the volatility has increased because of fundamentals, but also because of news, we've had to devote more resources to creating models that enable us to take as much data as possible. Part of the challenge we have, though, is that in some of these markets that we act, the data may not be as available as it is in, say, PJM or a UK market, right? So you have to start filling in with some assumptions as to what's happened in the past, and this is where you get into potentially into trouble, as Pierre was saying, and it is a challenge that we have at this point, filling in the blanks for when the information is not available, because your historicals may not help you the same way that they would have in the past. You're seeing weather extremes that you didn't see before, and you're also seeing reaction to political news that are very quick, that affect the market, and in some ways they want to make you react to that, and really discerning when you have to react to it or not. That's what's to me, the human element's still very important. You can't really let the AI take over and make decisions for you all the time. You can end up over relying on that, and then you're not making optimizing your decision making there. So that's a danger for us, the gaps in information, and also the over reliance on the AI, that we have to stay away from, and just keep the human element in place, at least for the time being. I don't see how you can get away from that.
It was interesting, the poll results that were coming in a moment ago that we ran. It appears that you probably, I want to say it was about 58%. Let me see if I can add here. 7, 6, 2, 3, 52% is basically everybody's got it in real time or near real time. So as y'all are saying, it's best that you can get everything in your structured deals in there, capture real time on there, so therefore your models are reasonably up and accurate with any other factors that you may have to input during the day fundamentally to get your whole book more to real time. Would that be a safe statement that you could make? In other words, you've got volatility coming in, but it's not really always long dated, right? So you're having to extrapolate value out into the future based on what your model inputs are relative to market pricing or dynamics or lack of availability. Is that kind of how you're having to score all that together, Al?
That is correct. And on the fundamental side, something to touch on is really the potential constraints you can have on the transmission side or on the pipelines. So again, that is something that's come up a lot, both on the power side, the transmission, and on the gas side. When you have a lot of pipelines constraints, you have to keep that in mind. It's
And
not only
are you modeling that with regards to our question here of intermittency, congestion, and imbalance? What's the one stickler in power that you got to monitor? Congestion?
congestion. Definitely, that's what you got to keep in mind. And even more so as we continue, we look at from a U.S. perspective, with all the load that's coming online, a lot of it, which is not going to come as quickly as people may think, but still a lot of it coming online. And then you start having those congestion events taking place, and maybe in places that haven't happened before. So you have to take that in mind and keep it in mind and make sure that you're modeling for that, updating the model for that.
Very good. Okay, Martin, I'll flip it over to you. You get to be the lone expert from Europe to give us that point of view, going over how you're doing your oversight, if any processes, or kind of explain maybe if you want to a little bit of your techniques about how you're capturing some of these physical risk as well as the financial risk and how that's all playing itself out for you being the risk manager.
So I think I will not tell different story than the colleagues. We have, of course, the key calculation is done overnight, as everybody does, but during the day, we have the ability to be very near online, real time, so to say, with the M2M and the risk measures. This is inevitable. In terms of, let's say, modeling the risks, as we are a prop house, so to say, at least my responsibility is for that type of department. So for us, it's slightly easier because we have the standard behavior, rather, let's say, mid-term to short-term position holding. So we are talking about mainly standard products, okay? Where we do not have a standard products, then we are talking about some gas storages and flexibilities. There you have to factor in also some potential constraints. And especially last couple of years, we have seen that the normal stress test is not enough, unfortunately, because there were events that nobody would able to foresee. So we are looking at the edges of the normal value at risk or expected shortfall and trying to define some really total black swan, even though nobody is able to make a forecast whether the price of the power will be 100 or 300 euro, or as we have seen during the Russian crisis, the gas went from 20 to 400 nearly. Okay, so I mean, it's very difficult. So what we normally do, and of course we are using the machine learning and other techniques to try to define the edges and to factor it in, as there is a very low probability of happening it, but it has a huge impact to the profits. So this is how we handle that. And based on this, we try to scale down or scale up some part of the business.
Let me ask you a question specifically about Europe, and we've kind of got you loaded here on because everybody. I mean, I traded in Europe. I think Al has. Al, you mentioned you were in Germany, correct? Talk a little bit about Europe. I think from a perspective of grid balancing and the batteries. How
Okay.
are you managing that risk with regards to that, Martin? Can you give us a little bit of an idea, and then I'll flip it over to Al for some comments as well, unless one of y'all want to go first or the other. Go ahead and ask Martin to go first.
Okay, so Europe is very well connected. So all the countries are very well connected. So you need to run relatively complex model where you factor in all the cross borders and the end passes, so to say, so that you can model price in each grid. For this is AI absolutely inevitable because especially for the flexible assets that are being optimized on the shorter end of the curve, then you have to have the online 24/7 data collecting and evaluation and forecasting and trading. So this is absolutely a must, and I cannot imagine that anybody could do it without any AI modeling. So I think, I mean, everybody does nearly the same. And then it is about how skilled are the people who are mastering those models and creating those models. In our case, our experience was that the LLC models developed so much, they are so advanced now that we are shifting from programmers into people who are able to deal with the AI. So the coding is being done already nearly without people, so to say. They are not really programming it, but the efficiency is extremely high. And that means that you can capture much more factors for the optimization process and for the decision-making process than we were able, for example, 6 months ago. That means the market will become, in the next 12 months for sure, much more efficient.
Okay.
Some opportunities will disappear maybe, but some will arise.
Glenn,
Go
it's
ahead,
been a
Al.
long time since I've managed my own positions in Europe, but just following it from a distance and also as an advisor in the past few years. As Martin says, the connectivity in Europe is different level compared to the US. It's always amazing to me how far behind the US has lagged in that sense as far as connecting the nation. Um, but what that means as well is the complexity of what you have to model because of the interconnections between the countries increases. What I've seen firms take the approach of as well is taking maybe through acquisitions of small companies that have the
Did we freeze?
expertise in
Mhm.
some countries, microgenerator firms
Okay.
that develop the ability in the specific markets, and then that way they acquire the ability to model things better on a continent-wide basis. So that's something that's going on as well.
Flip it between gas and power, Martin and Al, if y'all would. I mean, you spoke on power being that it's pretty much all AI because everything's connected. Is gas the same way? Very similar?
Yes, there's a lot of that, and I mean, in many ways, because of the liquidity, I think gas went that way first, because you have the players who had the pockets and the VAR to throw a lot more at a nationwide gas market in the US, which has eventually become a global gas market. Whereas on the power side, you're looking at more regional markets that sometimes the AI did not apply as easily to that.
Okay.
Gas has been going down the path of algorithmic trading and then AI use for a while, in my experience.
Yeah, I can
Martin?
confirm that the power is rather regional, so European, even though you have inputs from the international commodities, while the gas is purely a global commodity. So what we have experienced before 2022, it was also rather regional one, and you could model just Europe, but now it's not enough, and you have to have an insight of the Asian market and to monitor all the potential problems with the LNG. It means Australia, US, Qatar. So it's much more complex.
How well does it go over there with regard? I think you say it a BAX exchange, where you've got the LNG futures coming into Europe. How much has that helped or not helped in Europe as far as your modeling, your liquidity, and so forth?
Well, because of the LNG, the modeling in Europe became a bit more difficult because it's not regional anymore. Uh, so what I would say is that the models had to be extended for the Asian market. You have to model now the demand, what is going on in the Asian markets, and also what we have experienced. Also, the South America is picking up. So, I mean, it's really it. I would say it's not so complex, but you have to have enough information sources to be able to model it properly. And
Yeah,
especially data from Asian market is sometimes really hard not to crack.
sure. Martin, I mean not Martin, excuse me, Pierre. You're an LNG. How about you want to take that just from your side a little bit because you're more of an exporter, but I know you've got markets in Europe and probably globally. Are you having to handle that differently as well?
Well, as they mentioned, obviously it's very you need to capture the nuance between every market, JKM, TTF, and Henry Hub. They are correlated, and the correlation will change over time with all the new factor. What we're seeing now politically, but also what you're seeing with the growth of U.S. LNG that would increase the correlation between the market in the next few years, meaning that the mean reversion level would accelerate. The option value would then be lower due to higher diversification, higher correlation. One thing I wanted to touch base on is, of course, the traditional VAR model will have a lot of challenge to capture these phenomenons, but there are better techniques. I mean, there are techniques such as a Garch model with jump diffusion, a Poisson approach that would allow you to, if you model properly, to at least capture jump diffusion potentially, and then try to capture the effect. When should that happen? The classic example would be they announce X number of projects of LNG going online in the next 18 months. Well, the probability of these projects to be canceled or delayed is potential. So if should these happen, that would cause a price jump, right? For example, so you could model that and that allows some probability to these events to capture a tail risk that's more representative of the true risk, as opposed to just looking at historical data and try to see what's the 99th percentile based on the historical data. That's a classic way to do it. It's not wrong. The only caveat is that you may not capture the true tail risk and you underestimate the risk. So there are techniques that allow you to do that in that sense. Yeah.
Following up
But
on
by
that,
your answer, and I think all of the answers y'all have given, I'm gonna have to close it here, guys, because we got a couple of questions we need to take. You would
Sure.
say that you're using the same techniques you've been using for prior years. You're just doing it more effectively with technology. Is that a fair statement?
that is the first statement.
Yes, absolutely. Mm-hmm.
Yes.
Rather than go into a lot of AI technical stuff, go ahead, Martin, please.
Uh, in regards of the AI techniques, so I have already touched that. The relation between the, let's say, analyst or programmer, how you call it, and the large language models changed very rapidly. So what we were, let's say, programming, for example, in the past 1 month, it takes us now 2 days. It's such a big difference. And I have already touched that as well. We are now able to put into our models much more inputs. So the verification still needs to be with the people. You need to write the right prompts and to verify all the steps in order to avoid some mistake, because these LLC models are still spitting out sometimes quite stupid things. So from that perspective, it is amazing. It's helping. And as I said, the market will become much more efficient. I mean, just imagine how the techniques change within the last 6 months and what can happen within the next 12 months. It will not be rolled into the price efficiency maybe so quickly, but very likely we will be avoiding some huge mistakes, some big spikes driven by wrong positioning. Because you will be able, as a trader, as a trading house, to model much more complex problems much faster.
But at the same time, would it be fair to say that with all the increased volatility, some of it has affected some models, some of it has not really, because those are really more regionalized? Would that be a fair statement? And to that point, when you guys are looking at these kinds of models, you're getting them quicker, faster, you're able to build them faster, keep up with them better, and so forth. But there's got to be a testing period. Do you have a rule of thumb that has been altered to say, I'm not spitting out garbage, or I'm not spitting out false signals, that you as a risk manager are saying, I'm giving it these parameters? In other words, I've seen this in some of the clients I've had where someone has come out and it's a matter, there's a real difference of opinion as to how long you run the model to where it really is right. So since you brought it up, Mark, I'll ask you, but I think it's a good question to end on.
Yeah, that's very good point, actually. And that was at the beginning when we were defining everything, where the rules, how to verify all the steps so that we avoid exactly that situation. So whenever we are developing something, then everybody needs to follow that very strict rules in order to avoid the mistakes.
Yeah.
Oh,
Pierre, go ahead.
yeah, on exactly what you just mentioned, I'd like to point out that it's a concept of model risk management, really. So in the case of model risk, there are criteria, there are steps, there are fundamental principles around a model risk. One of them, of course, is the effective challenge. So whatever model you're trying to come up with, you try to find better models, right? You try to document the limitation. You try to replicate the results independently, and then having a second person view on it, right? So independent review, and then later on, then there's ongoing monitoring. So it's one thing to have a model production; it's another one to go back and revalidate this model, whether it's still the effective model or there's a better one. And that's typically what we were doing at the bank in model risk management. Now, one of the challenge is when there's a correlation breakdown and there's new information and we're in the unknown. For example, during COVID, that was the typical case where the models were predicting price of home going down when unemployment tripled in Canada, but that didn't happen because of government subsidies. But the models cannot predict something that is yet to happen. So the models predicting whatever they can try to predict with the data they have. So that's one of the risks. So it goes back to in case of failures, like who owned the kill switch and what are the measure to, use pragmatic approach when you're in complete unknown. It is still a case even with AI. It's still a model risk issue.
I was talking to
In the
somebody
global
the other
market,
day.
Glenn, the final point that I want to make in a global market, like LNG, for example, you have to be local if you want to get the global right. Because a lot of that information that's coming into your modeling globally is going to be only local, and you have to dig in whatever way you can to be able to get that, because otherwise your model's not going to pick up on that.
Yeah. And that's just the physical versus financial, correct?
Mm-hmm.
Correct. Yeah.
I was going to say, I was trying to explain to somebody the other day, the board, why is this happening? What's the biggest risk? And I said, probably for the risk managers, they need to get better cooling around their computers because their models are probably smoking every day. And I was trying to explain the variation of the models. And I told them, I said, imagine someone at a traffic stop has to turn right, and that's a foreign car or a truck or something, American car. They're going to closely make a right angle, but a big one's got to go around like a big ship, a long dated risk. That model's going to take longer to really give you some development versus that shorter term. And for some reason, everybody got it. So I guess I did something right in being able to explain that. We've got a question from the audience. We've got a couple of minutes here. The question is, can you give a concrete example of a position or a strategy you would have taken 2 years ago that you would have avoided today? I don't know what answer I would give, so I'm going to pick on Pierre. I'll just let you guys go through with real quick answers if you can for the sake of time here. Just what would you think about that, Pierre? How would you respond to something like that?
Okay, well, 2 years ago, for example, if the if they would enter in a structured deal, a long dated, without any option to cancel, for example, the option to cancel, well, that could have been maybe a classic example because the market was in a different state a couple of years ago, and the participant had a more classic example of how the market is between Henry Hub and TTF and JKM, and it sounded like a good idea. But if you fast forward now, given the high volatility and more uncertainty based on the global markets and condition, you may want to hold these options available to you, or you wouldn't give it up maybe at the same price. So the option to, for example, not take a cargo in 2 years is probably or change your view on a cargo in 2 years at probably greater value now than 2 years ago, for example, right? So that could have been probably a different point of view, right?
Martin, what do you think? How would you respond?
Yeah. I would go maybe a bit deeper than 2 years, and
Sure.
I would wish to have the ability to forecast these huge black swans, like was this Ukraine-Russia and this Hormuz event, because when we are positioning yourself in different grids, for example, in Europe, and also on the gas side as well, it's the same. It's fundamentally, you are trying to find a niche where the market is very likely mispricing it based on your calculations. And then something like this happens and you are being kicked very hard. So you have to escape. So all those positions I would love to erase, but it's impossible, of course.
I
Al,
would say
quickly.
I would say underestimating the value of U.S. exports on the LNG side, because the market was looking so flooded 2-3 years ago on a forward basis, and really not taking into account what could happen to the all those millions of tons per year coming out of Qatar. So the way it's changed this year, it's just it's a black swan is understatement.
Mhm.
So having taken a too bearish a view on the value of those exports, I would say.
Okay. Very good answers from all the panelists. I'll throw my 2 cents in closing statements here for the panel, or not just in the whole general thing of what we've discussed. I mean, the global market situation in energy went heavy renewable, heavy clean energy. Now we're all back to oil. So we've now got this diversification globally that I think people are having to deal with depending on what markets you're in. And as of each of the speakers has talked about today, you still got to maintain a fundamental approach as to what you're delivering and what you're taking while balancing your short and longer term risk so that you do have the ability to hedge, the ability to model it, and the ability to execute upon those actions from a physical perspective without having to get into legal and contractual risk. So it's, the thing that I think is concerning for some people is that you've even seen in the last 2 weeks where people are doing more counter trade swaps. You're back to a whole market like you used to have in the 80s of where metals for oil is coming in. The announcement of Chevron making a swap with another company coming in into Venezuela. You're starting to put risk on your books that are different and apart from commodities, but also from an M&A perspective. So there's a lot of creative situations going on. And I would say that from the panel's perspective today, the way they've outlined short and long-term risk and modeling of such and the maintenance of such, it's a very important, critical aspect of being able to have that fundamental approach as you move forward and this market's going to start changing and developing itself. It's not going to be day by day forever. It may feel like that, but it won't be. It'll eventually taper out. We just don't know really when. But I want to thank every member of the panel today for their insight, their subject matter expertise, and I want to thank all the people for attending the sessions today. I want to wish you a very good week to come with that, and with that, we'll sign off. Thank you for attending. We'll talk to you soon, hopefully being on one of the other webinars that is put on by Energies and Commodity Risk. Thank you very much.